macro currency signals.
There are moments in markets when something subtle shifts beneath the surface, and most people don't notice it until the price forces them to. We are standing in one of those moments right now. The real silver cycle has not exploded yet. It has not gone parabolic. It has not entered the manic phase that makes headlines. But the foundation is being laid quietly, structurally, and powerfully. And when it begins in earnest, it will not move politely. It will not move slowly. It will hit hard. You can feel it in the way markets react to stress. You can see it in the way capital behaves when confidence in institutions flickers, even slightly. The details almost don't matter anymore. A probe here, a political tremor there, a question about independence somewhere in the financial system. Whether justified or not, whether temporary or not, is secondary. What matters is perception. And perception in capital markets is reality. Before we go any further, if this perspective is connecting with you, make sure you're subscribed and that notifications are switched on. In a market like this, timing isn't just helpful, it's an advantage. Being early almost never feels comfortable. It rarely feels popular, but that's where true asymmetry lives. Drop a comment below and let me know where you're tuning in from and what time it is in your corner of the world. This discussion isn't limited to one nation, one currency, or one exchange. It's global. And when you recognize how broadly this signal is emerging, you begin to understand that this is far bigger than any single headline. Now, let's get back to what's quietly shifting beneath the surface. When global investors sense even a hint that monetary governance is being questioned, capital does not wait for legal conclusions. It does not wait for headlines to resolve. It repositions. The currency weakens, gold strengthens, and silver, at first slowly and then suddenly, begins to wake up. This is not about personalities. It is not about politics. It is about structural confidence. The modern financial system is built on trust in institutions, in central banking independence, in the rule of law as something stable and immovable. When even a crack appears in that perception, capital looks for something that cannot be subpoenaed, cannot be printed, cannot be politically pressured. That is where monetary metals come in. Gold moved first. It always does. Gold is the thermometer. It measures systemic anxiety before the public feels the fever. Over the past few years, gold began behaving differently. Traditional correlations started to weaken. Real yields would rise and gold would not fall the way textbooks said it should. The dollar would strengthen and gold would refuse to collapse. Something changed. This change has a name in quantitative language. Beta reset. That means the volatility profile and correlation structure of an asset are shifting to a higher regime. In simple terms, gold stopped obeying the old rules. It started pricing something bigger than interest rates and currency fluctuations. It started pricing structural risk. Now that same shift is beginning to appear in silver. For decades, silver lived in gold's shadow. It followed gold up and down, but with more volatility. It was part industrial metal, part monetary metal, never fully treated as either. Analysts would slot it into neat models. If growth was strong, industrial demand would help. If growth was weak, it would suffer. If gold rallied, silver would follow, but only so far. That model is aging. When structural change begins, it does not announce itself with fireworks. It shows up first in anomalies. Silver begins to hold levels it shouldn't hold. It rallies during conditions that historically capped it. It absorbs selling pressure and then grinds higher in an orderly fashion. These are the early signs of regime change. We recently saw a textbook example of how this transition looks. Technically, the market pushed to an all-time high, printed a sharp wick rejection, and then retraced violently. That kind of move scares people. It shakes out leverage. It resets sentiment. Many interpret it as the end. But what happened next matters more. Instead of collapsing into a prolonged bear phase, price stabilized. It began to work its way back toward the highs in a semi-orderly, constructive manner. That pattern has a name: cap trade and accumulate. It means that strong hands are absorbing supply. It means the correction was not distribution. It was consolidation. When a market makes a new high, retraces sharply, stabilizes, and then grinds back upward, it sets up a measured move opportunity. This is not hype. It is structure. You measure the depth of the retracement and project it above the breakout level. That projection becomes a signpost. Signposts matter because not everyone can sit through a multi-year macro thesis without reference points. Some participants need levels. They need milestones to manage risk. The depth from the recent high to the retracement low, projected above the breakout zone, points toward the low to mid-90s as an initial tactical objective. Is that the final destination? No. It is a checkpoint. There are three broad mindsets in a market like this. The first is the perpetual bull. The mindset that says it does not matter what happens next week or next month. The thesis is intact. The system is strained. Hard assets win over time. This group does not need signposts. They are anchored to the structural story. The second mindset is the long-cycle structural analyst. This view sees targets far beyond tactical levels. It sees silver not at 90 or 100, but at multiples of current prices over a longer horizon. It sees critical mineral demand, energy transition, supply constraints, and monetary stress converging. It is patient, but it still watches the data. The third mindset is tactical. This participant must manage exposure actively. They cannot afford to endure unlimited drawdowns. They need defined risk, defined stops, defined targets. For them, measured moves are tools, not predictions. They provide a framework in an environment where volatility is expanding, and volatility is expanding. When beta resets higher, price swings become larger. 10% weeks become normal. 15% corrections happen in days. Old stop distances become too tight. Old assumptions about normal movement no longer apply. If you trade as though the volatility regime has not changed, the market will punish you. But volatility expansion is not random chaos. It is often a byproduct of structural repricing. Look beyond the charts for a moment. Consider physical flows. For decades, futures markets operated with a small percentage of contracts ever standing for delivery. The vast majority were cash settled or rolled forward. Physical demand was a minor component of the paper market. That dynamic has shifted. Over the past year, the volume of contracts standing for delivery has risen dramatically. Month after month, unusually large quantities of silver have been delivered. Tens of millions of ounces in a single month. Truckloads upon truckloads of metal leaving exchange warehouses, and in many cases, not returning. Ask yourself a simple question. Who is taking that metal? Why now? And why repeatedly? This is not a one-off event. It is a pattern. When physical demand begins to assert itself persistently in a market, long dominated by paper positioning, something structural is happening. The old model assumed abundant, easily accessible supply relative to speculative flows. But if increasing quantities are being moved from registered categories into eligible, effectively off the market, the float tightens. Tightening float plus rising investment demand equals asymmetry. At the same time, silver's industrial relevance is not declining. It is increasing. Solar installations continue expanding globally. Electric vehicles require significant silver content. Electronics, medical applications, advanced technologies all depend on it. Governments have begun formally recognizing silver as a critical mineral. That designation is not symbolic. It reflects strategic importance. Now layer geopolitical fragmentation on top. Export restrictions, licensing requirements, state-sponsored allocation decisions. When nations begin to control the flow of strategic materials more tightly, the free market assumption weakens. Supply becomes political. And when supply becomes political, price risk increases. This is how cycles begin. Not with television pundits shouting, not with viral headlines, with quiet structural shifts that accumulate pressure. Think back to previous commodity supercycles. They did not begin with everyone on board. They began with skepticism. They began with disbelief. Early rallies were dismissed as technical bounces. Corrections were declared the end. But beneath the surface, inventories tightened, capital expenditures lagged, and demand quietly compounded. Silver today sits at the intersection of monetary distrust and industrial necessity. That combination is rare. Gold is primarily monetary. Copper is primarily industrial. Silver is both. And in periods where monetary credibility is questioned while industrial demand accelerates, that dual identity becomes powerful. Let's return to psychology. Markets transition from disbelief to awareness to acceptance to mania. We are not in mania. We are somewhere between disbelief and early awareness. You can tell because every rally is met with arguments about why it cannot last. You can tell because corrections are treated as proof of failure rather than normal volatility in an expanding regime. When silver ran sharply earlier and then corrected violently, many concluded it was over. But what if that move was simply the first wave? What if the correction was leverage being flushed out, setting the stage for a healthier advance? Leverage purge plus structural demand equals stronger base. The gold-silver ratio provides another lens. In early stages of precious metal cycles, gold often leads. Later, silver outperforms aggressively. The ratio compresses. Historically, during acceleration phases, the ratio can move dramatically lower. Extreme compression often marks euphoric phases. We are not there yet. But if gold continues its structural advance and silver's beta is indeed resetting higher, outperformance becomes likely. That does not mean straight lines upward. It means the amplitude of silver's moves relative to gold increases. And when that amplitude expands, people who are anchored to old ceilings will be forced to adjust. For years, silver struggled to sustain moves above certain psychological levels. Each attempt was capped. Each rally faded. That conditioning trains market participants to sell strength reflexively. But if the regime has changed, those ceilings lose power. What was once resistance becomes a launch pad. This is why I say the real silver cycle has not started in full yet. The groundwork is visible, the anomalies are visible, the physical flows are visible, the policy signals are visible, but the broad public is not engaged. The mainstream narrative has not flipped. Retail mania is absent. Cycles hit hardest when positioning is light and complacency is high. Add to this the sovereign debt backdrop. Global debt levels are unprecedented. Servicing that debt in a high-rate environment is mathematically unsustainable over long horizons. The path of least resistance historically has been currency debasement, whether gradual or abrupt. Hard assets reprice in that context, not because they are magical, but because they cannot be created at will. This does not require collapse. It requires gradual erosion of purchasing power and periodic shocks that remind investors of systemic fragility. Each time confidence wavers, gold responds. Each time gold establishes a new plateau, silver recalibrates. But let me be clear, this will not be a comfortable ride. If you expect silver to climb in a straight line, you will be disappointed. Expanding beta means expanding swings. There will be days where price explodes higher, and days where it drops sharply without warning. Margin calls will accelerate moves in both directions. That is what makes it powerful. When an asset transitions from being ignored to being essential, repricing is not gentle. It overshoots, retraces, overshoots again. It forces participants to adapt or exit. The key in this environment is not blind conviction. It is disciplined conviction. Understand why you are positioned. Define your risk. Recognize that structural change takes time to be fully recognized. And most importantly, recognize that we are not operating under the old playbook. The old assumption said silver was abundant, secondary, reactive. The emerging reality suggests it is strategic, tightening, and increasingly monetary in perception. Once that perception becomes widespread, valuation models will change, analysts will revise long-term price decks, institutional allocations will adjust, and the public, as always, will arrive late. By the time headlines scream about shortages or record prices, the cycle will be well underway. Right now, we are in the early structural phase. The foundation is setting, the pressure is building, the technical patterns are aligning with the macro backdrop. Physical demand is asserting itself, volatility is expanding, correlations are breaking. These are not random events. They are signals. The real silver cycle starts when disbelief turns into reluctant participation. It accelerates when participation turns into urgency. And it peaks when urgency turns into euphoria. We are not at the peak. We are not even at urgency. We are at the threshold. And when this threshold gives way, it will not feel gradual. It will feel sudden. It will feel obvious in hindsight. And those who dismiss the early signs will say it came out of nowhere. It will not have come out of nowhere. It will have been building, quietly, structurally, and relentlessly. And when it finally breaks into full view, it will hit hard. Now let's strip this down to the core, because cycles don't start with noise, they start with imbalance. Silver right now is sitting on imbalance. For decades, the futures market dictated the narrative. Paper contracts moved price. Physical was secondary. Very few contracts ever stood for delivery. Most were rolled, offset, or cash settled. That was normal. That was the structure. But what happens when delivery levels stop being small? When month after month, unusually large quantities of silver are actually taken out of exchange warehouses. When tens of millions of ounces shift from available inventory into strong hands? That's not noise, that's tightening. When metal leaves the system and doesn't immediately return, the float shrinks. A smaller float in a volatile asset is like dry wood in a forest. It doesn't take much to spark a large move once demand accelerates. Now combine that with supply constraints. Silver production doesn't respond quickly to price, because much of it is mined as a byproduct. New mines take years to develop. Permits, financing, geopolitical risk. None of it moves fast. So when demand rises, supply can't instantly meet it. That's the first layer of pressure. The second layer is demand itself. Industrial usage is not declining, it's expanding. Electrification, solar infrastructure, advanced electronics, silver isn't optional in many of these applications. It's required. That creates a baseline demand floor. But here's where it gets serious. On top of industrial demand, monetary demand is quietly returning. Not in a frenzy, not in a panic, just steady diversification. When confidence in institutions wobbles, even slightly, capital begins to hedge. Gold leads that move. Silver amplifies it later, and silver always amplifies. The gold-to-silver ratio tells this story. Early in a precious metal cycle, gold outperforms. Later, silver catches up violently. The ratio compresses. When that compression accelerates, that's when silver starts making outsized percentage moves. We are not at extreme compression. That means the explosive phase hasn't fully played out. Another shift is happening beneath the surface. Volatility expansion. Silver is no longer behaving like a sleepy industrial metal. Swings are larger. Reactions to macro events are sharper. Corrections are violent, but short-lived. That's classic high beta regime behavior. When beta resets higher, price doesn't climb neatly. It surges, pulls back hard, and then surges again. It shakes out weak hands. It punishes overleverage. But each time it recovers faster, it builds a stronger base. Psychology hasn't caught up yet. Most people are still anchored to the old silver. The metal that failed at breakouts, the metal that disappointed. That memory creates hesitation. Rallies are sold too early, breakouts are doubted. But repeated breakouts that don't fully retrace force behavior change. Short sellers cover. Underexposed funds chase. Momentum traders re-enter. That's how acceleration starts. And acceleration in silver is never subtle. Because the market is relatively small. It doesn't take massive capital flows to move price dramatically. A modest reallocation from institutional portfolios can create disproportionate upside pressure. When liquidity thins and buyers step in aggressively, offers disappear quickly. That's when price gaps. That's when it feels like it moved out of nowhere. But it didn't move out of nowhere. It moved because pressure had been building quietly for months or years through tightening inventory, structural demand growth, policy shifts, and shifting volatility regimes. We are not in mania. Retail isn't flooding in. Mainstream headlines aren't screaming about silver every day. That absence is important. It means the cycle is not mature. The real damage and the real opportunity comes when participation broadens. Right now, this is still a structural phase, a coiling phase, a positioning phase. If the breakout levels hold and new highs sustain, confidence will build. Confidence fuels participation. Participation fuels imbalance. Imbalance fuels acceleration. And when acceleration comes in a high beta asset with tightening supply and rising demand, it doesn't tiptoe. It hits hard. That's why this is no joke. Not because of hype, not because of prediction, but because the ingredients of a powerful cycle are aligning at the same time: structural tightening, expanding volatility, shifting psychology, and growing strategic importance. When those forces converge fully, silver won't ask for permission to move. It will simply move, fast. So here's the bottom line. This isn't about hype. It isn't about chasing headlines. And it definitely isn't about a quick trade that disappears next week. What we're watching unfold is structural. It's slow pressure building inside a system that most people still assume is stable. Silver is no longer behaving like the old silver. Physical flows are tightening. Volatility is expanding. Correlations are breaking. Strategic importance is rising. Monetary confidence is being questioned more openly than it has been in years. None of these forces alone would be enough. But together, they form something powerful. Cycles don't announce themselves politely. They start quietly, they frustrate people early, they shake out the impatient, and then when participation finally broadens, they accelerate in a way that feels sudden and unstoppable. We are not at the euphoric phase. We are not at the screaming headline phase. We are at the threshold phase, and thresholds are dangerous, not because they guarantee upside, but because once crossed, they change behavior fast. Capital moves faster, liquidity thins faster, price discovery becomes more violent. That's why this is no joke. The real silver cycle doesn't creep higher in small, comfortable increments. When it truly begins, it reprices. And repricing in a high beta, tightening market doesn't feel gradual. It hits hard. The question isn't whether silver can move, it's whether you recognize the pressure building before everyone else does. Because by the time it feels obvious, the move won't be waiting.